One of the limitations of fiscal policy is the relationship between expansionary fiscal policy and national debt. That is, when we use expansionary fiscal policy, we increase government spending and we lower tax revenue. This leads to a budget deficit, and budget deficits year after year become debt. So let's look at Canada's debt. So here what you see in the line, both on the left and the right, is federal debt. Now when we look at Canadian debt, we also have provincial debt, and this just looks at the federal aspect of it. We also have to distinguish between net debt and gross debt. So when we look at net debt, that's when we are subtracting away any of the assets the government has. So in that case, we look at, okay, what does our government own? Do they own land? Do they own airports, or do they own national parks? Those could all be liquidated and pay off some of the debt if necessary. So net debt will always be lower than gross debt. Gross debt is the total amount that we owe, and it comes from having deficits year after year. So let's look at public debt across countries, and so this is not just federal debt, but it combines municipal, provincial, federal as well. And so we can look at and we see that Canada's public debt as a percentage of GDP is 99.4%, just under 100%. Now, when we compare it to other countries, there are other countries whose debt is much higher. So for example, Japan, its public debt is more than twice its gross domestic product. So how come we're not hearing all about Japan in the news? Why isn't there more panic if Japan owes twice as much money as they make in all the goods and services? Well, it really comes down to who owns the debt. Okay, so when it comes to debt, governments fund their deficit spending by issuing bonds, and those bonds are bought by investors, right? You buy bonds, and then 10 years later, for example, they mature, and you have earned interest. They've increased in value. So it really comes down to who owns that government debt, who buys those bonds. Well, in Japan, most of the Japanese debt is owned by the Japanese. In which case, if the government defaults on its debt, it's its own people that it's defaulting on, and they're the ones that are spending the money anyway. So it's not as big a deal as if your debt is foreign owned. When we look at Greece, for example, their public debt is 179% of their GDP, so almost as high as Japan. The difference is that 80% of Greek debt is foreign owned. A lot of it is owned by banks in Germany, for example, or where the European Union's banks have bought their debt and it's being sold as investments. Perhaps you might own some Greek debt if you have any bonds or mutual funds that have invested in international bonds. So it's all foreign owned. Well, the problem with this is that if Greece defaults on the debt, then it's people in other countries who don't have a relationship with Greece, who aren't in Greece, who aren't the people benefiting from the government spending, who are left without their money. And in fact, this has been an issue for Greece because a number of European banks have refused to lend Greece any more money until it changes its tax structure. It changes some of the methods the government is using to ensure that in the future they would actually be able to pay back some of this debt. So Greece has actually had to liquidate a number of its assets, including selling government-owned ports of entry, so where ships go. They've had to sell those to private companies to help liquidate the assets so that they could pay off some of this debt in order to get more loans in order to accumulate more debt. And there's a video you can check out on Blackboard about Greek debt. So if debt is a problem, because nobody will lend us money if we have too much debt, and that seems to be a problem across lots of countries, and then the bigger problem is who owns your debt. Let's talk about who owns Canadian debt. Okay. Well, when it comes to Canadian debt, about 21% of Canadian debt is foreign owned. The majority of Canadian debt is owned by Canadians in terms of pension funds and investments within financial institutions. Okay, well, what about the U.S.? Who owns the U.S. debt? Well, 34% of U.S. debt is foreign owned, and we can see that of that, China is one of the largest owners of U.S. debt. They have about $1.3 trillion in U.S. debt. And so what does that do? Well, that makes the U.S. accountable to China. If the U.S. wants to continue deficit spending and incur more debt, then they're going to need someone to buy their bonds to give them money to keep operating, which means they got to keep China happy, or else China is not going to continue buying their debt, investing in the U.S. in terms of bonds. And so it makes you beholden to the country who owns your debt. So the last thing you want to do is start a trade war, for example, with the Chinese, because you need their money to keep your country operating so it doesn't shut down. So let's look at what impact having debt has on the economy. So what if you have an economy that has lots of debt? How does it impact you? Well, the first thing is, if you have a high level of debt, then you are very risky. And just like if you have lots of credit card debt, then how do you get a credit card company to lend you more money? Well, they're going to charge you a much higher interest rate because you're high risk. So if you're too risky, no one wants to lend to you. You have a decreased ability to borrow. And in order to entice people to lend you money, you're going to have to pay a higher rate of return. So with your credit cards, the higher risk you are, the higher the interest rate on your credit cards. The same is true with the government. If you're too risky to lend money to, like Greece, nobody wants to lend you money, then you're going to have to pay a lot higher interest rate to entice people to do so because of that risk. If we look at Greece, for example, in 2011, a 10-year banknote had a rate of return in Greece of 35%. To give you a comparison, a 10-year note in Canada, the same time period, had an interest rate of just over 2%. So you can see the impact that having too much debt has on your interest rates. Well, the challenge with high interest rates is that if you already have a bunch of debt, it makes it harder to service the debt. Because now the money that you're still outstanding, the money that you still owe, is now much more expensive. And you didn't have the ability to fund your government without borrowing to start with, and now it's going to be even more costly to fund the government because you're going to have to pay even more money on the money you borrowed. So what do? Well, you could increase taxes, have your people pay more in taxes, increase tax revenue. This would help pay down some of that debt. Well, the challenge with this is if you increase taxes, you're doing this at a time period in which your government is already spending more than it's bringing in tax revenue. Well, likely this is happening because you're trying to help a poor economy. And so you're raising taxes at a time where you actually need to be lowering taxes and increasing government spending because your economy's not doing well, which is why you've ended up with all of this debt. So what else could you do? Well, you could print money. We've seen videos this semester about Argentina and Zimbabwe who printed money, and it's led to hyperinflation. And the problem is that when you have lots of debt and no one will lend you money and you can't afford to borrow, you're paying huge interest rates, and the only way to help pay down some of that debt is to raise taxes on your population, which is already struggling, then the only resort left is to print more money, increase the money supply. And the problem is this is not a good option. This is the last resort because when you increase the money supply, you create inflation. All of your goods now need more money to buy them. And so you're hurting a hurting economy even more. And so it's really tough when countries get into this area of having too much debt because there's no pretty way to get out of it. As we saw with Argentina, as we saw with Zimbabwe, there's no nice fix. Everything just kind of makes it worse. On Blackboard, you'll see a video called A Guide to American Debt. Perhaps you checked it out at the beginning of this level to kind of give you an idea of what it's like. So it's a satire of what it's like when a family is borrowing money, but the same thing is true when the government borrows money. Right? No one will lend you money. It's high interest rates. What do? How do you keep operating? Well, in the US, what they keep hitting is what is called they keep hitting their debt ceiling. So the debt ceiling is a number to help the US understand at what point they have so much debt that they can't even afford to pay the interest on the debt. And so when you look at this chart here on the right, the debt ceiling is in red, and then every time the blue hits that red, they've hit up against the debt ceiling. So that's the point at which they can't borrow any more money because beyond that, they couldn't even afford to pay the interest on the debt. Remember, when we looked at the tax revenue in the US, if you took Social Security, Medicare, Medicaid, and the interest on the debt, those three were more than their tax revenue. So the US has a problem where they keep hitting this point at which they can't borrow any more money because they couldn't pay the interest on it. And the satire, the video that you watch, shows how, well, we just borrow it from the future. And so what they've been doing is doing things like borrowing it from Social Security, hoping to pay it back later to get by because they need a way to not have to externally borrow any more money because they can't afford the interest on the debt. And now we've gotten to the point where they hit the debt ceiling in the US about twice a year. Okay, and sometimes this comes the same time as the government shutdown, where not only can we not borrow any more money, but at that point, the existing money has run out. Okay, so the government the US is in quite an issue where they have too much debt. And as we look at countries like Canada, we're not that far behind. Now, we said that having too much debt impact your interest rates. What you see here is Greece and high interest rates on their bonds because of their high debt. Ireland, Portugal, Spain also have high levels of debt that we saw in that previous chart. And so what you see here, this big increase in the returns on their bonds, it comes as their debt has drastically increased. So you ask the population, okay, what do we do with all of this debt? Would it be better to increase taxes, to cut government spending, to do some of both, do something else? And we all say cut government spending because a lot of government spending doesn't impact us directly. Most people aren't a fan of increasing taxes because it does impact them directly. But when you cut government spending, that does mean jobs. And we have seen protests. So here you're seeing some pictures of protests. We've seen anti-austerity protests in England, in France, in Greece. And these are all protests on decreasing government spending. Because if you decrease government spending, that means laying off workers. And in countries like Greece, where almost half the population works in the public sector, so they work for the government in some form, that has a big impact on the economy. So raising taxes, lowering government spending is not very beneficial for your economy if your economy is already struggling, right? You can't, if you're laying people off, then they're not going to buy goods and services. If people are paying more in taxes, then they're buying less goods and services. So it's going to have a ripple effect. So the problem with having too much debt is you really lose control of being able to use fiscal policy to stimulate your economy. You can't increase government spending. You can't lower tax revenue because you can't afford to borrow any more money. No one will lend you money. And you can't afford the interest now that you're a much higher risk. So let's look at Canadian debt. Where did Canadian debt come from and why is it so high? Well, we're actually still paying for World War II. In fact, World War I only just ended in 2010. 92 years after the last gun was shot. And that's because it wasn't until 2010 that the last of the debt on World War I was paid off. So now we're still working on World War II. Then we have, in the 70s, an increase in income support programs. So remember how when we looked at our government spending in Canada, the biggest portion was transfer payments? Well, those transfer payments started in the 70s. So they're income support programs like EI and other welfare programs. Well, the challenge is they started in the 70s at the same time that interest rates were really high. So if we borrowed money to increase government spending in the 70s, and we borrowed money at really high interest rates, well, we're still paying off that debt. So high interest rates in the 70s and in the 90s mean that the debt we have is very expensive debt. The other reason that we have high debt is because of counter-cyclical fiscal policy. And counter-cyclical fiscal policy, we are closing the gaps. So with counter-cyclical policy, we are closing a recessionary gap by increasing government spending and decreasing taxes. And if you're decreasing taxes at a period of time where the economy is already in a recession, so tax revenue is already low because people's income has dropped, and we're cutting taxes even further to help stimulate the economy, then we're going to add to the debt. Government spends more, we have less tax revenue, we have deficit spending to help close the recessionary gap, and it's adding to our overall debt.